Silver investors woke up to a situation few believed was possible this early. China has just taken a step so sudden and forceful that it rattled markets from New York to Singapore. Overnight, physical shipments were redirected, major industrial buyers found themselves shut out, and Asian mints quietly started reporting delays. According to a handful of insiders, this is merely the opening phase of China's long-term silver agenda. If the initial data is accurate, silver isn't simply trending upward. It's accelerating toward the $63 mark with momentum nobody can contain. And yes, China is the one who pulled the trigger. To understand the real story, we need to look at what unfolded over the last few weeks that the mainstream media is barely whispering about. China's domestic silver stockpiles have shrunk to their lowest levels in nearly a decade. Inventories on both the Shanghai Futures Exchange and the Shanghai Gold Exchange have fallen to levels not seen since 2015. Yet in a twist that left analysts speechless, China exported more than 660 tons of silver in October 2025, the highest monthly export figure ever recorded. This is the part that needs unpacking. China is not importing more silver. They're exporting unprecedented amounts at the very moment their internal inventories are collapsing. That imbalance triggered backwardation, when futures prices fall below spot prices, a clear distress signal from the market that physical silver is urgently needed right now. Instantly, premiums across Asia spiked. Futures markets shook, bullion supplies tightened, and silver smashed past $60 on December 9th before hitting a fresh all-time high of $64.20 on December 11th. The real question is, why would China orchestrate something this dramatic? The answer becomes clear once you look at the forces converging all at once inside China. First, the country's solar boom is growing at a pace no one predicted. Chinese solar installations jumped more than 30% in a single month, and by the end of the year, the country was on track to install close to 300 gigawatts of capacity. Every one of those solar panels requires significant amounts of silver, and China's solar industry consumed more than 6,000 tons of it last year. This demand curve is still rising. Meanwhile, the global silver market is staring down its fifth consecutive year of supply deficit. From 2021 to 2025, the world has racked up a cumulative shortage of roughly 820 million ounces, an amount that cannot simply be fixed by turning a dial or speeding up mines. China's EV sector adds even more strain. Electric vehicles consume far more silver than traditional cars, and China is the world's largest EV producer. At the same time, new solar cell technologies, like TOPCon panels, use significantly more silver than older designs. China is effectively doubling down on technologies that require massive amounts of physical silver, even as global production remains flat. Add to that geopolitical friction. The U.S. initiated a review of potential tariffs on critical minerals earlier this year, and silver appeared on that list. Chinese exporters responded by shipping as much silver as possible to the U.S. ahead of any restrictions. While this caused COMEX inventories to balloon on paper, China's domestic supply cratered. Another layer of China's strategy involves its currency. Beijing has quietly reduced the US dollar's share in its currency basket while boosting yuan-based trade. More than half of China's cross-border transactions are now settled in yuan. And with the opening of a new gold storage hub in Hong Kong, China is building the infrastructure to support commodity-backed yuan contracts. Silver fits perfectly into this long-term blueprint. The West talks about paper markets, but China is positioning itself through physical supply, an approach that becomes devastatingly effective when global shortages intensify. Western markets were already fragile when China made its move. COMEX inventories look enormous at first glance, but only a fraction is truly available for delivery. Much of it is eligible, meaning it belongs to private holders who are not obligated to deliver into futures contracts. Mine production has been slipping for almost a decade, ore grades are falling, and new mines take years to bring online. Industrial demand, on the other hand, is hitting record highs, over 680 million ounces last year alone. The Silver Institute expects another deficit of up to 117 million ounces in 2025, and cumulative shortages could approach 1 billion ounces within 5 years. Refiners are operating at capacity and cannot increase output fast enough. Import data paints an even clearer picture. China imported 3,700 tons of silver in 2024, and the solar industry alone is expected to need more than 260 million ounces in 2025. Chinese buyers aren't playing with futures. They want metal in hand. Premiums on Shanghai silver have repeatedly climbed high enough to offset China's import taxes entirely, which means industrial consumers are willing to absorb heavy costs just to secure supply. When the world's largest solar manufacturing base needs silver to stay alive, buyers face two choices: pay the price or shut down production. Neither option favors the West. Analysts are sounding alarms. TD Securities warns that China's rush into physical metal could drain Western markets dry. London traders reported severe tightness, and lease rates in late 2025 soared to double-digit levels, something that typically signals extreme scarcity. UBS and Bank of America have already raised their price targets, with some analysts now calling for $100 silver before the end of 2026. China's dominance over 80% of the global solar supply chain adds an enormous advantage. If China ever restricts silver exports the same way it did with rare earths, Western manufacturers would be crippled within weeks. What's unfolding now is part of a far larger endgame, reducing U.S. dollar dominance by building a commodity-backed alternative. China is steadily accumulating hard assets, from gold to rare earths, and silver is the next logical component. Unlike gold, silver is small enough for a single nation to influence easily. The entire global silver market is tiny compared to gold, treasuries, or crypto. This means China can shift the market with relative ease, especially when industrial demand is already pressuring supplies. And unlike gold, silver's industrial utility gives China an excuse to accumulate large amounts without drawing attention. The cracks in Western paper markets are already visible. J.P. Morgan's reduced short exposure, London's shrinking vault reserves, and the widening gap between physical and paper prices all point to a market struggling to meet real demand. In many Asian regions, physical silver now trades at steep premiums over official spot prices. This is what happens when the paper price becomes a fiction and the physical market takes over. The surge toward $63 is not driven by speculation. It is the logical outcome of 5 straight years of supply deficits and ballooning industrial demand. As silver climbs, the consequences begin to ripple. Solar manufacturers face rising costs, EV producers see their margins crushed, and global green energy targets fall behind schedule. Western banks, holding mountains of paper contracts, could face a nightmare if more traders begin demanding physical delivery instead of cash settlement. If silver surges past $63 and continues climbing, we could witness a chain reaction. Retail investors will jump in once mainstream news starts covering the rally. Government interventions, from export controls to strategic reserve releases, are not off the table. But what should worry Western policymakers the most is that this is still only phase 1 of China's strategy. Beijing could easily ramp up imports, announce a national silver reserve, impose export restrictions, or even roll out a commodity-backed currency basket involving silver. Any of these moves would send shockwaves through global markets. The roadmap ahead is straightforward. Breaking above $50 signaled the end of the old trading range. Surpassing $55 confirmed a new bull cycle. Crossing $60 marked a fundamental shift in supply and demand. And now, the push toward $63 represents a panic phase driven by tightening physical availability. Beyond that, the scenarios range from a controlled rise to a potential parabolic spike toward $100 or more if shortages intensify. China didn't stumble into this moment. The collapse in domestic inventories, the export surge, the solar boom, the currency strategy, and the timing with global deficits, none of it is accidental. This is a meticulously coordinated plan aimed at increasing China's leverage over both industrial supply chains and global monetary systems. Silver is no longer a forgotten metal in the shadows of gold. It has become a strategic asset in the world's most important power struggle. And while the West debates futures contracts and technical charts, China is quietly accumulating the one thing that ultimately sets the price: physical supply. With silver racing toward $63 and analysts revising targets upward every month, the real question is whether this trend continues. It's what China plans to do next. Because if the past few months are any indication, the West is still several steps behind in a game China has already mastered.